Sentiment has shifted in a very big way. Markets are struggling, yields hitting 5%, and key levels of support are starting to come into play. But more importantly, breadth indicators, which looked green like a Christmas tree just last week, are starting to come under pressure in a very serious way, and this demands our attention. 20-day, 50-day, and even some 100-day moving averages are starting to come under pressure for all of the major sectors, except for this sector right here. And this is very telling, because higher yields, higher oil, and a higher risk premium only lead to one nightmare scenario: higher inflation, hyperinflation. So what happens to stocks when an entire rally is built on easier financial conditions and those financial conditions don't materialize? Today, we're going to talk about that, look at the past history to see what normally comes next. We're also going to talk about earnings. We got some very big hitters who have reported earnings, and we need to talk about it because they often will determine the path for the rest of the sector. Did they beat or did they miss? We talk about it all here today. Let's dive in. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe. We're trying to get 10K subscribers by May and hit that notification bell. Let's get into it. Guys, a very mixed day of trade. We even saw stuff like energy, materials, utilities lose today, but there were pockets of green. United Health did lift the healthcare sector. We did see consumer defensives do really all right, and semiconductors had a lot of tailwind. The first was some super micro price target upgrades, and the second was earnings tomorrow. ASML and TSM report earnings in the next couple of days, and I think semis are just running up into those earnings. Other than that, it was pretty red across the board. Look, industrials, there was green here, there was red there. Healthcare, there was again very much a similar situation. Same with financials. I mean, capital markets were all right. Visa, MasterCard, American Express, PayPal did good, but the rest of banks didn't do so well. Now, looking at sectors, the best performing sectors, guys, the only positive sectors was technology, right? Semiconductor, software, so pretty much like the tech space, and then metals, mining. Other than that, it was either flat to down for every other sector, including the SPY. I mean, have a look at the worst performing sectors. Gold miners down 1.49%, and then XLRE, ITB, okay, real estate, on a couple of things. Number one, we had terrible housing data today, just shocking housing data, and so they took the brunt of it, and the pain continues in real estate. It's crazy. We saw quite a lot of volatility right here. This had to do with Powell's speech. Now, he came out, said a whole bunch of hawkish things, but he did start off his speech with saying a couple of dovish things, and so the market rallied here. And then he pretty much finished off saying, hey, the fight against inflation, it's ongoing, progress is stalling. And that literally took June cuts off the table. It's looking like the first 25 basis point worth of cuts is going to come in September. But, this can get moved down at any point. Look at the November probabilities right here, 41% and then 28.2% of a 50 basis point cut. And pretty much September is the only time left the Fed have to cut rates before the election. And then it's after the election. I believe the election is the 5th of November. But let's actually hop on the charts and have a look at everything. Alright, so looking at the S&P 500 down 0.21%, the nasdaq actually finished green, and again that had to do with mega caps. The RSP down 0.55%, mid caps pretty much the same, S&P 600 the same. IWM up slightly after hours but also down on the day, and actually outperforming some of these other indices. Very weird trade that's going on there, but we actually saw again growth outperformed value, although up 0.21% in after hours trade there. Very, very weird. But overall, guys, it was another horror show of a day. Look at the 2-year yield at 4.985%, nearly 5%. Did it touch 5% on the day? It actually did. The 2-year yield was at 5% on the day. And yeah, financial conditions are definitely tightening. Bonds continue to rally to the downside, and TLT, what an actual horror show. Look at this year-to-date performance. What is the percentage return? Negative 10.1%. Your 4%, 4.5% coupon is not going to cover those losses for the year. Guys, Bitcoin continues to falter. I mean, this is a year-to-date chart. Up big year-to-date, but you can see definitely forming some form of a flag right here. Gold price action is stalling out at the top too. I believe the same is true with silver. The dollar did gain on the day and continues to make gains here, and then crude at the $88 level continues to find resistance and is moving lower. It's making a succession of lower highs and then lower lows, so we should see some downward action. I think we could probably pull back to this level right here and then see more price action up in crude oil. But let's hop on the S&P 500 really quickly, have a look at everything. So I know the week is not done, we're not going to do weekly analysis, but just looking at the weekly chart, the weekly candles, very grim, 3 red weeks in a row. We could see right here that we're at the bottom of the range for the week and we're approaching very critical levels. Now we are looking at a very key zone. We've been talking about this all week, and it's this zone right here to right there. It's actually just changed this to regular. And it's pretty much the 49.80 zone, right? Or the 5,000 level, all the way to as low as like 49.20, pretty much like right here, the bottom of this range. And that's really a massive level we're looking at right now, the first level of resistance of support for this market. And I do think that this is probably when we're going to find some pretty crucial support. If we actually just look at the daily candle, we could see, look at the selling pressure that ensued today. There wasn't much with regards to this candle, this candle, this candle, this candle, this candle. Just look at the volatility. Not a lot of volatility in regards to what we've seen in the past week. So that is a plus for the bulls. Nonetheless, you have to look at this as a red day. And I do think that today was probably just a day where we stalled out, maybe some shorters taking profits, maybe a bit of, I wouldn't say a dead cat bounce, but just a bit of short covering we probably saw earlier on in the day. But I do think that we're probably going to see continued downside here to this 5,000 level and to as low as 49.20 into OPEX, maybe even after OPEX a couple of days after that. But this is where I'm expecting the first significant bounce to occur. And hopping on the 5-minute chart just to see what we did on the day, we actually virtually did nothing. I believe we opened right here, right? We opened at this level right here and then just traded sideways. Very muted day of trade, especially negative gamma, to see this type of volatility. This is the type of volatility you see in positive gamma. So not much to go off on the 5-minute chart right there. So what am I looking at tomorrow? Well, look, there's not much I am looking at. I mean, we could definitely just bounce from here on another like green day tomorrow held by mega caps if we get like good earnings, right? We could definitely bounce from here, but really the levels I'm looking at are 5,000 and then 49.80. However, I do want to point out something on my Twitter. I said that the likely path is that a sell-off to around 5,000 at near OPEX, and then we lift off. We're looking for opportunities to add long exposure on short-term weakness. The trend is up. Now, this isn't an exact science, and what you guys have to understand is that the path is what you really want to look at. And the path right now is sort of like a sell-off to this key zone and then a rocket higher. So the levels might not be completely exact, but you want to look at the overall path. We could definitely bounce from here. It's very likely that we do continue down this way, and it could definitely, look like this on the way down. It could definitely just look like that. There's many different variations of path to get to this level, but I do think we eventually get there. But again, a lot is going to depend on earnings. Semiconductor earnings. We saw quite a rally in semiconductors, and they were just rallying into the earnings we're going to get for the rest of the week. ASML, Netflix, Disney as well, Taiwan Semiconductor, and those have been the momentum plays for the week. So we could actually see a little bit of upside momentum towards the end of the week here, especially because we are in the thick of earnings season. But you do have to look at this trend. This is an ugly candle. This is a red body candle. We are putting in lower highs. We are putting in lower lows. We are on a daily downtrend, but still a weekly uptrend. So you don't want to fight the trend on the weekly, but you also don't want to ignore the trend on the daily. And you just want to buy at key levels and sit through the volatility. The earnings grind continues, and today we're going to be looking at United Health and Morgan Stanley, so capital markets and healthcare, which are two very important stocks in each sector. Morgan Stanley reported earnings per share of $2.02 against the expected $1.66, so they absolutely smashed earnings out the park, and those earnings were on revenues of $15.14 billion. They were up 4% in pre-market. I didn't dive into why they did so good exactly. I just looked at the headline numbers, so I'm guessing it was a mix of higher net interest income, higher assets under management, and less overall credit provisions. I'm gonna assume that's why this number was so good, and that's why they were so upbeat in pre-market. Now, I am recording this pre-market, so the end of day figures might be different. United Health absolutely smashed earnings too. They beat EPS by 29 cents, reported $6.91 of earnings per share on revenues of $99.79 billion. They beat by $490 million, and shares were up 7% in pre-market. So both here on the Morgan Stanley side as well as the United Health side, very upbeat earnings. The street definitely did like these numbers, at least pre-market. Again, very different after the close. Nonetheless, I think these are great results from two heavy hitters in the healthcare space and capital market space. So how exactly are we doing here for earnings season? So far, we're doing a 6% beat rate with 80% beats on EPS. You can see that we have every single sector right here, earnings as well as revenue growth. And right now, the S&P 500 is tracking 1% growth with 30 companies having reported so far. That's 0.2% quarter over quarter, 3.2% year over year in revenue, but actually down 4.1% quarter over quarter in revenue. That being said, excluding energy, we're looking at 3.7% growth, excluding financials and energy, 3.6% growth here in the S&P 500. And we can actually see that out of the 30 companies that have reported, 80% have reported EPS beat rates, 53% have reported top line beats, and both have beaten at a 53% clip. So we only have 30 data points right here. It's not really anything to go by. When we start getting, 200 plus, not this week, but the week after next, when we really get into the thick of it, when we get some of the heavy hitters in the index, that's when we could really start taking some of these numbers at face value. But as it is right now, there's no discernible trend, and we do have to wait for more data to come in. That being said, earnings so far, so good. But breaking it down into each sector, out of the 11 sectors, only 5 are expected to see earnings accelerate in Q1. Sectors expecting to see earnings acceleration are comm services, energy, technology, real estate, and utilities. Now, it's not as grim as it seems, because if we actually break down into the weeds, this is what we get. 21% growth here in comm services. We know the big names there: Netflix, Disney, Google, Meta. Then we have discretionary, 16% growth. Okay, Amazon's in there. Then we have growth here in technology, heavy hitter, semiconductors, Microsoft, Nvidia. Then utilities up 22%, but coming off a dumpster fire of a year for earnings. And then real estate 3% plus. Then we actually have a look at the sectors that are decreasing. Materials, energy. The reason why they have 27 and 26% decreases is because of the inflationary scare in 2022. We had really high inflation. Commodities as a result rally. What comes after that? Higher commodity prices. When commodity prices alleviate, you're naturally going to get a decrease in earnings in stuff like materials producers and energy producers. Then we have a very similar situation here to healthcare, down 26%. Why? Because of the pandemic. Revenues got inflated because of the pandemic, and now they're normalizing. And that's exactly what we've seen in the material sector, the energy sector, and the healthcare sector. And then we have a 1% decrease growth in industrials. And considering that throughout 2022, 2023, industrial stocks actually grew earnings, can you really fault them for this? Then when you put all of that into perspective, you actually look at it and say, okay, yes, only 5 are expected to see earnings accelerate. But when you break it down further, there are reasons as to why. But then in the second quarter of 2024, it actually flips the script, where only 5 sectors are expected to decelerate their earnings, and 1, 2, 3, 4, 5, 6 sectors are actually expected to see earnings acceleration, with the only 2 sectors lagging here are going to be materials and real estate. So all in all, Q1 seems to be an inflection point here for earnings, and then we really start to see acceleration in the second quarter of 2024. But there's a lot of expectation built into these earnings estimates as of right now. And the market right now is increasingly becoming more earnings driven than it is multiples driven. 53% of the return contribution since March has been driven by forward earnings per share growth over multiple growth. As you can see right here, this blue part is when the bulk of the returns were driven by multiples, as you can see throughout most of 2023. This dark blue represents earnings expansion, and right now we're in an earnings driven market because earnings are coming in hot right now, simply because number one, revisions are tracking well above the historical average. Now, here's the situation, right? Let's say I have a stock. It trades at a 10 PE with growth of 10% for the quarter year over year. Leading up into its earnings report, it rallies 10%. And let's say for the earnings, there's no upward or downward revisions. Chase Holdings reports earnings. It comes exactly in line, 10% growth for the quarter. Now, essentially, the PE multiple stays the same because the stock rallied 10%, but also reported 10% earnings growth. Nothing has changed. It still trades at 10 times. That is called earnings price expansion or earnings expansion. Now let's use the exact same company, the exact same stats, Chase Holdings right here. So we have a 10% growth expectation, 10x PE, and we rally 10% into the earnings. But while we rally 10% into the report, earnings actually gets revised down by 1/4. So instead of 10% growth, they're expected to report 7.5% growth. And let's say the stock rallied 10% into its earnings report, earnings come in line. Essentially what that means is that the company has rallied 125% on its earnings, which means 25% of that earnings was multiple expansion, and the stock's multiple will either have to perpetually trade higher on an 11x PE, or the multiple will have to compress via pullback in price or time. And essentially what this data right here is telling us is that earnings expansion and multiple expansion are driving both the stock market, whereas just last year it was completely just an expansion in the multiple. And after having 12 to 18 months of a rally driven by multiples, this is exactly what you want to see. At the same time, financial conditions are getting tighter here in the US, especially after that strong March CPI report, but they've actually eased in Europe, as you can see right here. This is the financial conditions index. Both in Europe and the UK, financial conditions have eased, but they've starkly increased here in the US. And that's why we're seeing a little bit of volatility in small caps, in large caps, in stocks as a whole, as well as bonds. It has to do with financial conditions accelerating. And that's just because month after month, we just get stronger economic data points, whether it's from retail sales, employment, inflation reports. Everything just comes in really, really strong. And it really goes to show the strength of the US economy. And this is why BofA have changed their Fed policy rate projections to reflect these tighter financial conditions. And they expect the terminal rate now to be 3.5 to 3.75% in this cutting cycle, up 50 basis points from their previous forecast. You can see this is the median FOMC projection. This is BofA's old forecast. This is their new forecast, and previously their projections were right here for the end of 2024. The problem is, what happens if these projections right here get pushed out further into 2025, 2026 on stronger data, high inflation? And you see, that's what the stock market is trying to price in right now. That's why we're experiencing the volatility we are right now, because part of the rally that we've seen in stocks in the last 6 to 12 months was largely based on forward earnings, as well as easier financial conditions, lower rates. If we don't get those lower rates we were expecting in 2024, they start getting pushed out closer to 2025, maybe into 2025. Something has to give, and at the end of the day, that's stock prices. Now guys, we've been seeing a lot of volatility in the market, but did you know that the average monthly return of long-short S&P 500 momentum factor since 1980 is actually negative here in April? You can see that in April, you have a 2.5% negative return on the momentum factor. And then when we actually think about it, what are momentum stocks in this market right now? Semiconductors, technology, they're real momentum stocks. And then we actually break it further down. We have a look at VanEck Semiconductor ETF Seasonality. We go to April. You can see that the 10-year average, negative 1.1% in April. The worst single month happens here in April. Then we go into May, the best ever month. So some of the selling we are seeing, yes, it has to do with the macro picture. Yes, it has to do with the fundamental picture, but it also has to do with the technical picture. On a technical basis, April is the worst time for semiconductors. And we do know that if semiconductors start selling, technology starts selling, and if the tech sector starts selling, that brings the whole market down with it, especially with the rise of passive investing. Now let's talk gamma. Now looking at gamma, guys, a lot of negative gamma in the tape. All of these put and call sellers, these option sellers, just got wiped out after a very small 4% move to the downside in the last 2 weeks. Gone. They're off the tape. None of them exist anymore. And the core gamma resistance strike is still at 5,300. The gamma flip keeps moving down. It was at 5,200 on Monday, by the way. Now at 5,165. And 5,000 is still the put support level. And that's going to be our target into OPEX. And guys, once all of this gamma rolls off the tape, we want to see where it rolls to. Where do these strikes roll to? Do they stay at 5,300? Do they move up? Do they move down? And then we can focus on the next targets into May, into April. So right now we're looking at 5,000 into April. If it stays at 5,000, that will continue to be our main area of support, looking for potential buy zones to bounce to the upside into May. However, if this does move down the tape, that probably does mean we get more downside action. But as it is right now, what we really want to see is this move slightly lower into the tape right here. If we can get this moving to 5200, 5100, we're going to see significantly bigger moves in the S&P 500. And I think we're going to see a lot of negative gamma build into the tape into May. However, if this stays at 5300, there could be some support for the bulls right there. But all in all, you have to look at this, and this is bearish. This does favor more downside action. And yeah, I just can't believe how all of the option sellers got absolutely wiped up, because pretty much we get into positive gamma because of option sellers. You know, they sell calls, sell puts, and then dealers have to hedge appropriately. And that's why they have positive gamma in the tape. Negative gamma is just a lot of downside protection. So we got a lot of long puts and not necessarily long calls. But yeah, you know, people buy calls and it can be hedged as negative gamma sometimes. But for the most part, it's mostly just long calls, downside protection, convexity protection. But anyway, guys, that's it right there. 5165 is the gamma flip, but everything points to more downside, especially going towards the 5,000 area into this OPEX. Now guys, looking at market breadth, this is S&P 1500 new lows breadth dashboard, and we could see things are starting to get really grim in the market right now. S&P 500 percentage of stocks at 10-day lows, 62%, and we're starting to see some of this seep into 20-day lows, and we're also starting to see it seep into 63-day lows, which is 3-month lows. So, you know, stocks are really coming under pressure. These shorter term breadth metrics, which were coming under pressure, are now seeping into the longer term breadth metrics. 16% of stocks at 63-day lows. However, these longer term breadth metrics are still favorable. They're still looking very healthy. And we could see this is actually reflective across the board. Utilities, industrials, consumer defensives, comm services, not so much energy. Energy right here is the outlier. However, every other sector is seeing quite a number of their stocks at 10-day lows, 20-day lows, and we're starting to see stocks approach their 3-month lows or 63-day lows. At the same time, the bull market behavior checklist, just last week, this was at 8 out of 9. We are now at 6 out of 9. So things are really starting to break down in the market. Now guys, looking at some more market breadth charts, this is the core leadership model, and we've officially hit below the zero line right here. That means we are no more in strong leadership. Leadership is very weak. That coincides with breadth metrics turning lower. Probably means that we are in a short to medium term risk off environment. This is also reverberated in the risk on, risk off indicators. This is the short term right here, the medium term, and the long term. And we can see that the short term indicator has switched into risk off. Same with the midterm indicator right here, while the long term indicator remains in risk on. So short term breadth metrics are definitely turning lower. These are risk to the markets. CTAs follow this type of stuff. Computer trading algorithms follow this type of stuff. They look at indicators that are risk on, risk off. They look at momentum indicators, breadth indicators, and then determine path from there. And in the short term, we are ticking lower, and that probably means we're going to see more sell side in CTA algorithms. And we know this to be true because we have the data. This is SPX and CTA positioning. As you can see, the S&P 500 has rallied all the way up since October. We have actually seen quite a bit of weakness come into the market right here. This has been followed by CTAs, and there is a lot more downside convexity left here in CTAs. And according to Goldman Sachs, who give us this data, they believe there's still another $59 billion worth of downside convexity, which would take us very close to the lows we saw here in late October 2023. This is a chart I wanted to bring to your attention, guys. Out of all of the sectors here in the S&P 500, only 3 of them are outperforming the index as a whole. Now, firstly, I want you guys to take something into consideration. This right here says infotech. This is actually the industrial sector. I don't know why it's infotech. It says XLI right there. XLK is this sector right here. And we can actually see that energy, comm services, and infotech have outperformed the SPY. Every other sector, including the NASDAQ 100, financials, technology, materials, consumer staples, healthcare, utilities, discretionary, and real estate, have underperformed the SPY, and in some cases have just been a downright dumpster fire for the year 2024. I'm looking at real estate, I'm looking at consumer staples, but they are starting to form a bottom right there. Other than that, we have had a number of other sectors outperform the S&P 500 for the most part, but we've seen material weakness in the last week or so. We can see this is true for financials, here materials as well. Utilities are starting to perk up a little bit, but the S&P 500 has still outperformed this sector for the most part. Now looking at data in this week ahead, guys, so today was the 16th. We have mortgage applications tomorrow and net long-term TIC flows. So data for the rest of this week is going to be very, very light, but we do have some big earnings for the rest of the week with Netflix, ASML, TSM, and hopefully those provide a tailwind for equities. Guys, but if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.